We saw how we enter data from the 990 form for current assets, cash and cash equivalents and other current assets. And now we move on to the next line, which is, as you see, investments, and there is a reference to the 990 form, still part 10, lines 11 to 15. So let's see that. Okay, so again, the 990 form, and you can see lines 11 to 15. Okay, most of them are empty. What we have here is investment in publicly traded securities, and then we have investment in other securities. In general, these figures represent funds that are held by the organization, but they're not, let's say, 100% liquid. So traded securities is supposed to be liquid. You know, you can, your computer, you can make them liquid in like 1 day or sometimes even 1 hour. But there may be securities that are less liquid. There may be under some kind of restrictions, and therefore they appear in the balance sheet as investments and not as cash and cash equivalent. And we can see the number 6,864,000. If we move to our Excel, so you can see this figure here. Okay, all right. So this is the figure here for investments. By the way, I don't remember, did I say that I go over the exercise this class or the next class? Yes. Okay, so I'm not that confused. All right, so this is investment, appears as a separate line. Then we have the line fixed assets with a reference to line 10C. Okay, so here we have to give some explanation. So until now, all the assets that we have discussed were financial assets: cash, receivables, which is cash that we are supposed or about to receive in the coming year, and investments. Fixed assets represents all the assets that are not financial. That can be computers, desks, chairs, cars, property. In this case, it's a museum, so they have property. Any investment in the property, like air conditions, plumbing, etc. Also, under fixed assets, we will have investment in software, website, which is also considered fixed assets. So what is the difference between, let's say, I purchase for my organization a printer, a toner, and a bunch of paper to print on. So the pages and the toner will be registered as operating expenses and will appear in the statement of activities that we'll see later on. But the printer is considered as a fixed asset. Now, the borderline between fixed asset and regular expense is whether we are going to use the item in the next year, the next 12 months. So everything that is supposed to be used within the next year is considered as disposable material. That would be the pages, the toners, and everything. The printer has economic life which is longer than 1 year. You probably use it for 3, 5 years, maybe even more. So that is considered as a fixed asset. As a result, it will not appear in our expense report. When we look at the report of income and expenses, we will not see the spending on the fixed asset. We will only see it here in the balance sheet in the table that I'll show you later on. Okay? Now, how do we represent fixed assets in the balance sheet. So the non-profit world, lucky for us, continues the old way of recording investment in fixed assets at cost, which means that if I bought a printer and I paid $500, it will be recorded as $500 in the balance sheet. The business world moved to a different method, which is called, the long name is IFRS, sometimes referred to mark-to-market, which basically assumes that you have to reevaluate every year the value of your fixed assets according to market value, which is probably easier to do with properties, but with old printers and all the desks, it's a little bit difficult, which means they have to pay a lot of money to assessors that will do that for them. But in the non-profit world, it is still presented at cost. Okay? Now, if you look at line 10, you can see that we have 10A, 10B, and then a reference to 10C. The number that we use in our Excel is what we see in 10C. Okay, so we enter the value, let's say, here for the end of this year, 34,789,000. So first of all, let's see, just to see that we get the right number. So fixed asset, this is the number that we use, okay? 910C. But, I still need to explain what is the 10A and 10B. So, as I said, we register every piece of equipment when we buy it, when we make the purchase, at cost. However, a printer that I bought today has a different value 3 years from now. There is something which is called depreciation or amortization, okay, which reflects the fact that if I buy a piece of equipment when it's new, it has a certain price, but if I want to sell it 2-3 years later on, it will be worth less. You all know that when you sell your used car, you will not get the same price as you bought it when it was new, okay? So depreciation is an estimate which is reflected in the financial statement, and the purpose of depreciation is to reflect the fact that the value of our fixed assets, except for real estate, if this is what you want to ask, Gonzalo? No. Okay, so go ahead.
How do you determine that?
Depreciation. So I'll explain in a minute how it's determined. But except for real estate, which is a little bit different, depreciation reflects the fact that there is a reduction in value. Now, the most common method, which is in non-profits, I think it's 100% of the cases, is the straight line method. So what is the straight line method? There is an economic lifespan for each piece of equipment. If you remember, we talked about it in the previous semester. This economic lifespan is not determined by us, but by some professional, like the bar of CPAs in the United States or the equivalent in Israel. There is also determination by the tax authorities. So, for example, cars will have a lifespan of 7 to 10 years. Electronic equipment used to be 5 years, now it's shortened to 3 years, okay? Furniture, I don't know, maybe 8 years. Air conditions, 15 buildings, not the land, the building itself, usually 40 years. So there is a determined lifespan, and the depreciation is calculated accordingly. So if, let's say, I have a piece of equipment which I bought for $1,000, and let's say for simplicity that the economic lifespan is 10 years, okay? So since the time that I bought the equipment, every year I have to deduct 1 divided by 10, 10% of the value. So if I bought it for $1,000, let's say that I bought the equipment exactly at December 31st of the certain year. So it will be reflected this year at the value of $1,000. Next year, I have to deduct 10%, $100, so it will be reflected as $900. The year after that, $800, $700. After 10 years, the book value of this piece of equipment will be zero. It may have market value, I may be able to sell it, but in the books, in the accounting system, it will appear as zero. So for every piece of equipment, I have this depreciation. Now these $100 that I deduct from the value of the fixed assets will appear also as an expense when I will look at my statement of activities. So I will get back to that later when we talk about statement of activities, but this is something that distinguishes accounting from, I would say, daily management of income and expenses, that in the financial statements I have estimates. The most common estimate is the depreciation. It's not a real cost. It's not something that I actually spend. It reflects the fact that the value of the equipment depreciates, goes down, and it also gives me a kind of early warning that sooner or later I will have to replace the equipment, right? I can't use the same equipment forever, and I have to keep money for that. So that is the one of the roles of depreciation. Okay? So again, to repeat, the fixed assets are written at cost. The value that we have here in 10A is the historical cost of all the fixed assets that were bought by this organization from the time of its inception. So the $65 million is everything that was bought by this organization. This organization can be 20 years old, so I don't know, 100 years old, I have no idea. So this is a lot of purchases during the year. The value that we have here in 10B is the accumulated depreciation for each item that was purchased, how much we depreciated. And the net in 10C is the net value of the fixed assets. Now, under the assumption in a simple environment in which we don't have any real estate, so the depreciation in general more or less reflects the actual reduction in value of all the fixed assets. And I can assume that if I have to sell all my fixed assets, this is more or less the amount that I will be able to receive. Okay? Again, it's an estimate, it's not an accurate figure, but it gives us a sense of what we bought and how old is the equipment. Obviously, the older the equipment, the less will be this value of the net fixed asset. Yes, Nanda.
Might be out of Maru's question, but what do you mean? Because I can imagine the example with a small NGO with some stuff, but in a big NGO with all the things that they have, that would take ages to do it.
Or ages to do what?
To take the I forgot the word, like
depreciation. The depreciation. Well, you know, we live in the old time, my time, when you used to do it manually on a piece of paper, but now it's all computerized. Okay. So you have a report for each organization, a computerized report of all the equipments with the purchase value, which is registered anyway, and then depreciation is calculated automatically. Yes, Lisa.
Can you ever show us how such an accounting system looks like? Like if you don't use stuff in Excel?
Well, you know, there is a report. It's different between countries, but it's so much not important for our purposes. Yeah. Because first of all, you will not have to do it. And second, and you will see later on that when we will move to the analysis of the financial statements, the fixed assets will not be material for our analysis because when we look at the ongoing operation of the organization, the assumption is that you don't sell anything, right? You don't sell your computers, your chairs, your desks, your air conditioners if you want to continue your operation. So the fixed asset will not be very important apart from how much was invested in fixed assets. So that we will see. So I'm explaining to you how it's being calculated. It's not something that you will ever do yourself. When you prepare the financial statements as a director, you submit a report of income and expenses. The auditor will take all the rest from cash from the bank, receivables from your report, and they will do the estimate for the fixed asset. There is no involvement of you as a director. Yeah.
Whatever, I understand the perspective of the product has a value of 1,000 euros, and like every year its value increases by 100 euros. But if I write my budget for next year, and I know that we're going to buy 2 new laptops, am I going to put 2,000 euros in the budget or 200?
So you have to put the purchase, the investment, the actual investment, but you have to remember that although in your budget they will appear, let's say that you start a program, and the program is accessibility to technology for children with low income. And you look at the budget for the program, and you have staff, you have material, and you also you want to buy laptops, right? You need the technology itself. But when this is recorded in your accounting system, you have to remember that the salaries and the disposable materials will be recorded in one place, which is the operating expenses. But the purchase of computers will not be recorded there, it will be recorded elsewhere. And you have to ask for this figure in order to follow up on that on your budget. Okay, that is a very important point. Sometimes we forget it when we ask for the ongoing expense report from our accounting system. If you don't have a bookkeeper who is trained enough to understand the different needs of management and financial accounting, they will not give you the expenses on equipment while you do want them in order to follow up on your budget. So that is something that is important to remember. But what you need for your budgeting is the actual spending on the purchases. So that's when we do the analysis of the financial statement, we want to move from financial statement to actual management, we have to take into account that. Okay? Now, depreciation is completely irrelevant to our management of operation because it's not something that we are going to spend. Okay? So therefore, we'll have to take it out. And again, we will see that later on. So right now, we want to see when we do this financial statement thing, we have two stages. The first stage is reading the financial statement. And the purpose of moving the data from the financial statements or the 990 form to the Excel file is to make sure that we read it correctly. And then using the file, we will do the analysis and the file will do the calculation and we will do the understanding. Okay? Now, if we go to the actual financial statements, still here. Okay, so if we go to the actual financial statement, you can see the same figures. Investments, 6.864, and property and equipment net, 34,789,000. See here in the financial statement, it doesn't even show you the at cost and accumulated depreciation. Usually it is shown in a note at the report later on, but here we only see the net. Okay, so these are the same figures. Okay. All right, so once we did that, okay, we entered all the data from the 990 form, lines 1 to 2, 3 to 9, 11 to 15, and 10C. Okay, we have the yellow line, which is the total assets of the organization. Okay, if you want just to check yourself, there are several checkpoints here just to make sure that you didn't make mistake in the data entry. But you can check yourself by going to the 990 form, and you see you have this figure of total assets right here. Okay, in line 16, you have this figure of total assets, and you can check yourself that the sum of what you have in the Excel is exactly what you have here, or in the financial statements, you have again the same total assets. Okay, this line doesn't say total assets, but it's the total. Okay, the financial statements in the American form are a little bit less informative, and that is why I use the 990 form. Okay, so that basically ends the total assets. And before we move to the liabilities, are there any questions regarding data entry or what we have done in assets, in the asset side? Okay, so now we move to the other side, which is the liability side. Now, it's a little bit confusing, the term, and I will investigate in the explanation of this term. But in general, we should think of the liability side as sources of funding, which means I have assets. Everything that I have, starting from cash, commitments, investments, fixed assets, had to be funded from somewhere. Okay, so the liability side shows us the funding sources, and it is basically divided to two components. The first is funding sources that are external, okay, not belonging to my organization. And the second, the net assets, which we will invest sometimes, are the internal sources of funding. But let's start with the external. So the external begins with current liabilities. In the same way that we have current assets, we have current liabilities, and a reference is to lines 17 to 21. So let's have a look. Okay, so you see this is the line between 16 and 17 is the line between assets and liabilities, and 17 to, what did I say? 21 are the current liabilities. Now, in the same way that when I talked about current assets, about receivables, current assets are all the income that is recorded for this year, 2016, but was not received by the end of the year and is expected to be received within the next year. Usually, when the time that the report is prepared, it was already received. And we saw there was grants, pledges, etc. Current liabilities, the same thing in relation to expenses. All the expenses that are recorded for this year, for 2016, but were not paid by the end of the year. Examples, accounts payable. Okay, so accounts payable, this is something that, if you done some actual management, you're probably familiar with that. When the year ends, December 31st, in January and February, usually you get a lot of invoices that relates to the previous year, accounts that were not yet paid. But these expenses relate to the previous year. So although you received them, let's say in this example, in January, February, maybe even March 2017, you will record them as expenses of 2016. However, in the bank, they are not reflected in the balance for December 31st. So they will be reflected as accounts receivables. Okay? Now, there are also accrued expenses. It's not specifically stated here, but this is something that at least here in Israel is very common. Salaries and payments to tax authorities, social security, pension funds, okay, all the benefits are paid. In Israel, salaries can be paid until the 9th of the next month, okay? So salary of December, let's say in this example, 2016, can be paid until January 9th in 2017. Payment to the tax authorities by the 15th of the next month, or sometimes by the 19th. Payment to pension funds, again, by the 15th. So usually what happens is that when we end the year, the bank for December 31st does not reflect salary payments of December, benefits payment of December, and taxes for the employees for December. So these are also part of the current liabilities, because these salaries and these additional expenses for salaries are for December 2016, but they were actually paid in January 2017. Okay? So these are also part of the current liabilities. And what else do we have? Deferred revenue is also something that there is an equivalent of expenses in advance in the current assets and deferred revenue in the current liability, which means that if somebody gave me money for something that I haven't performed and I'm supposed to do it next year, then I have an obligation, a debt in terms of expenses that will occur in the next period that I was paid in advance. So this is also a current liability. Okay? So in our Excel file, let's look at the number here. Current liabilities in 2016. I have 17 to 29, and let's see where we got it from. So I have here one figure. See, in 2016, I have one figure, 195. In 2015, I have two figures. So if you go to the Excel file, you can see that here in 2015, if you look at the line up, you can see that these are the two figures that appear in lines 17 to 21. So again, let's be very technical, because at the end of the day, we have to look at the forest and not on the different trees. What you do is you take the data in the 990 form from lines 17 to 21, and you insert them here in the current liabilities. Okay, and then we will see later on in the analysis that basically we want the overall picture of the organization. So current liabilities are commitments, obligation, or debt, short-term debt. We also have long-term debt, okay, which are lines 22 to 25. So let's have a look at them. Okay, so lines 22 to 25, you can see loans, secured mortgages, etc., etc. So we have one figure here, 583. So these are basically loans or debt that we have as an organization, which is expected to be paid not in the next year, but in the years after that. Okay? Usually when you take a loan, if you remember, we talked a little bit about loans, I think we talked in the previous semester, you have principal payments and interest. So interest will appear as an expense, but the principal payment, the outstanding debt, will appear here. And what will happen is that, let's say we have a loan of $500,000 for the next 5 years. Okay, the first 100,000 is supposed to be paid next year. This will appear as a current liability. However, the additional $400,000, which are supposed to be paid from not next year, the year after that, and after that, and after that, they will appear here as outstanding long-term debt. Okay? And again, if we go to the financial statements, whoops. So you can see the same numbers, okay? The current liabilities and the long-term debt. And again, in the Israeli format, these numbers will appear in separate boxes, current liabilities and long-term debt. In the American format, you have to guess. And again, that is the reason that I prefer to use the 990 form, which is more informative in terms of what to put where. You don't have to guess anything. Okay? So this is basically the long-term debt. Let's see again that we have the same numbers. So in the long-term debt, you can see that we have the two numbers that appear in lines 22 to 25, 583 and 34,000, which is basically what we see here. This number in line 23 and this number in line 25. Okay? All right. So this basically covers the more understandable part. And now we have to move to the less understandable part of the net assets. Now there is kind of a summary here which sums the total debt of the organization, long-term and short-term. And we have another part, another component of the financial statements, which is called net assets. This is the most confusing. So first of all, why do we have in the liability side something which is called assets? And we had the asset side, and we had all the assets, and suddenly we have another assets appear in the liability side. So what we have to remember is that the entire structure of the financial statements was designed for the business world and was imported to the non-profit world. But during the importing process, some of the definitions are not the same. In a usual corporation, what you have is in the liability side, you have the same current liabilities and long-term debt in the liability side. And then you will have something which is called equity. Equity is basically the amount which the corporation owes to its shareholders. As you know, the normal way of incorporation in our modern world is that you have shareholders. They are the owner of the corporation, and the corporation, they don't necessarily manage the corporation. I mean, if you have savings, pension funds, if you invest in the stock exchange, you probably have stocks of different corporations in your portfolio. Sometimes you don't even know it because you don't know exactly what is the investment policy of your pension fund. But you are owners of corporations, like you may be owners of Microsoft and Apple and Amazon, but you don't manage these companies. What you do enjoy as owners is the capital gains when the value of the stocks rises, and dividends if the corporation decides to distribute dividends to its shareholders. But the equity side is the commitment of the corporation to its shareholders. So in case that the company is in default and they close the operation or it is sold or whatever, then the corporation will take all its assets, will sell all its fixed assets, will take all its financial assets, will pay all its external debt, and the rest will go to the shareholders. So this is actually a liability of the corporation to its shareholders. Now we import the same structure to the non-profit world, and we don't have any shareholders. Okay, non-profits do not have shareholders. And even in certain cases, there are certain structures of non-profits. Like in Israel, you have a public benefit company that does have shareholders. They are not allowed to distribute anything to these shareholders. So this whole thing of liability to shareholders does not exist. So what does the net assets represent? As I said, it represents the source of funding, which is our internal saving. I'm going to show you how a balance sheet of a family, household, will look like in some very simple example, so that hopefully you will be able to understand the meaning of net assets, because the meaning of net assets in a non-profit is very similar to the meaning of net assets in our individual life as a household, okay? So let's say that we have cash of 120,000, okay? So in our personal terminology, we will relate to it as cash. In the financial statement terminology, we will relate to it as current assets, okay? Cash is part of current assets. So this is the human language, this is the accounting language, okay? Then we have different kind of saving plans, pension funds, etc., long-term saving that will be referred to as investments in the terminology of financial statement, and saving in our personal language. And right now, we don't have any, we live in a rented place. We don't have any apartment, so we live in a rented space, but we want to buy an apartment. But right now, the apartment is zero. So altogether, our total assets, the sum of cash and saving plans, 720,000 whatever shekels, dollars, okay? Now, how will our sources of funding, which we call liabilities in the financial statement, will look like? So first of all, we have some debt. We're not debt-free. We have a debt of 5,000 shekels, let's say, in our credit card, which means we did the purchases, but the payment will not be at the end of the month, but will be a few days later. So that, in the language of the financial statements, are current liabilities, okay? The debt of the credit card. And we don't have any loans. We didn't take any loan. So our accumulated savings, okay, will be the difference between our assets and our liability. So what does it mean? It means that when I ask the question, where did the money came from, the cash and the savings, where did I get the money from? So 5,000 of it is kind of a loan that I received from my credit card company, and the rest is my internal saving. I had to create this saving. I had to save enough money so that I will have these 715,000. Okay, so the accumulated saving, which is called net assets in the financial statements, is how much I brought from home to finance my assets. Okay, and also it says here, it is the net value of all the assets. Okay, let's move it so that we can see. Move it a little bit so we can see the net value of, it's not this line, it's this line. The net value of all the assets after all the liabilities were paid. So basically, let me again return to the numbers just to, so we are in this table. So if I take all my assets, cash and savings, and I pay my debt to the credit card company, this is what is left, 715,000, and that is my net assets, which has basically twofold meanings. One is the difference between my assets and liabilities, and the second, it is my accumulated saving. Okay, I will show you how these two terms basically they are the same thing. Okay, now, so let's complicate the issue a little bit further. So now I decided that I want to buy my own apartment. Okay, this family wants to buy an apartment. And in order to buy the apartment, so they look and find an apartment that costs million, let's say, shekels. Very difficult now, but just as an example. Now, how do they fund the purchase of apartment? So they decide that they can withdraw from their own resources 250,000, 150,000 they will take from their cash. So they will decrease the cash reserve from 120 to 20, and 150 they will take from their savings. So they will withdraw from the savings 150. The rest, 750, will be taken from as a loan, as a mortgage. Okay, so they take a mortgage of 750. So let's see now how their balance sheet will look like now. And this is period 2. The first one was period 1. This is period 2 with /A, because we will want to see another presentation. So what happened? Current assets or cash went down from 120 to 20, right? 100,000 went for the apartment. Also, saving plans went down from 600 to 450, because 150 I withdrew for the apartment. Now I have another line here, which is the apartment at cost. Okay, 1 million shekel, and that will appear in the financial statement as fixed assets. So altogether, my assets increased from 720 to 1,470,000. Yes, Harry.
But like the apartment is different than rent, right? Or it is rent?
No, rent is an expense.
Yeah.
The apartment is an asset. It's yours.
Oh, okay. So
when you live in a rented apartment, you can't sell it and get the money, right?
So this is like owned.
This is owned. Yes, that's why I said purchase of apartment. Okay. I decided that I'm tired of paying rent. I want to own my own apartment. So I take a mortgage. I have some money from my savings and I buy the apartment. So my balance sheet, the asset side, will look like that. How will the liability side or the sources of funding will look like? So I still have the debt to the credit card company. That hasn't changed. Now I have on the loan side 750,000. That's my mortgage. And this will appear in my balance sheet as long-term debt. Okay? And the net assets will not change. I still have my saving of 750,000. Okay? The same amount of saving. And this is still the same amount if I now liquidate all my assets, which means I take my cash, I liquidate my saving plans, and I sell the apartment, assuming that I get the same million shekel. Let's say I buy it and I sell it in the same day, so I get the same million shekel, and I will pay all my debts to the credit card and to the mortgage company, to the bank. I will still have this same amount of 715. So I have the same amount of saving. The fact that I bought the apartment cannot change the past. My savings are a result of everything that I did in the past. So I have the same amount of savings, but now I'm in a little bit different situation, because in the previous period, my entire amount of savings was in financial assets, cash and saving plans. Now, part of my saving is in the apartment. Okay, only part is in financial assets and part is in the apartment. Okay, I have savings in bricks and mortars, as you say. Okay, so, but the total amount of saving does not change. Now, let's move to the last part, which is what we see in the analysis of financial statement. Okay, so the table period 2A reflected what happened to me, or what will be my situation if I liquidate all my assets, if I sell the apartment. However, in my normal life, and if you think about an organization that wants to operate does not plan to sell its fixed assets. Think of an NGO, you have computers, you have chairs, you have cars, you have air conditions. You want to continue your operation, you don't plan to sell them. So what I want to see is a measure for my financial position under the assumption that selling the fixed asset is not an option. Under the assumption that I keep the fixed asset, still I want to know what is my financial position. And this is reflected, and this is the most important and also the most confusing part of the net assets, we'll see immediately in the analysis. This is reflected in the following two yellow lines. So first of all, my asset sides remain the same. Okay, current assets, the cash, the saving plans, and the apartments. Also, my external debt remain the same. Okay, the 5,750. But in order to reflect my position without selling the apartment, I present my net assets in two lines. The first is called net assets for fixed asset, and it is by definition the same value that I have in the fixed assets here in the apartment, or the fixed assets in the balance sheet. And the second line, net assets for operations, is basically the value of my financial assets, only my financial assets without the apartment, minus all my obligations. My obligations are obviously financial. Okay, my commitments are always financial. And here you can see that we have a negative value of minus 285,000. Now the sum of 1 million in plus and 285 with a minus is exactly 715. Okay, the math cannot change. But basically what it says, this line of net assets for operation, which is the net value of all the assets, assuming that we don't sell the apartment, okay? This is the most important measure of my financial position in the long term, and it is usually referred to, and you will see in the table in the Excel, as my operating reserve. Here in this case, it's not exactly a reserve, it's a deficit in my operating reserve. Basically what it means that in my regular operation, I do not have enough financial assets to cover all my obligation. Okay? And this is a very important figure in assessing the stability or vulnerability of a nonprofit. Here it's my household, because basically what it says that in case that I have to repay all my loans right now, I don't have enough money. I have a deficit of this amount. Okay? So now let's go back to our Excel and then the 990 form. So here I have the net assets. And first of all, let's go to the 990 form and introduce another complication that we have in the nonprofit world, okay, which we don't have in our private life. So as you can see, we have three lines here: unrestricted, temporarily restricted, and permanently restricted. And it refers to lines 27, 28, and 29. Okay, so let's see these lines. Okay, you see 27, 28, 29. Well, first of all, we have the numbers. Okay, and we just copy the numbers to the table. So we have unrestricted, 33.88, temporarily restricted, and permanently restricted. So what is this restricted? So that we already know, we already discussed at length that one of the unique features of the nonprofit world is that our income is, in many cases, designated, restricted to specific project, to specific programs. It's not free income that we can do whatever we want with. Now, what happens is that at the end of the year, when the accountant goes over the income and expenses report of the organization, they would look and ask the organization management how much of the income was designated, how much was undesignated. Then, of the designated income, how much was actually spent. So let's say if you have a grant, let's say of $1 million for a specific project, if you spend all of it, great. But if you spend only half of it, let's say $500,000, so you have a reserve, kind of surplus, okay, of $500,000 that goes to next year. But this is not a free surplus. This is not your money that you can use and do whatever you want with it. This is a surplus for which you have a commitment to your donor to spend it on that specific project. It's like obligation to the donor. It's in a way similar to obligation to the bank that you have to pay your loans. The only thing is that you spend it on your programs, but still it is not a free reserve. So all these amounts, all these surpluses that are from restricted sources or designated sources will not appear as unrestricted surpluses, but will appear as restricted. Now, the terms temporary and permanently are not very important, and I think they even canceled them lately, and they are all temporarily. It used to be, for example, temporarily is everything. Every designated grant that you receive is basically temporary. You have to spend it within a certain period of time. In the past, they used to refer to what is called endowment funds as permanently restricted. But then they realized that even endowment fund has some kind of a terminal point in which you have to spend them all. So I think now they are consolidated together. For our purposes, it's not important. We will relate to everything which is restricted as restricted. Okay, because from our point of view, it's not money that we can actually spend on whatever, if we have a deficit or if we have a shortage in income or something else. But since it is presented in the 990 form as two separate lines, I have presented it also in the Excel file as two separate lines. So if we go to the Excel file, you can see that we entered the numbers, okay? And once we enter the numbers, the first step is to make sure that there is no mistake in data entry. Okay, so you just enter the number line 27, 28, 29, you enter the figures. Here you have a checkpoint. You see, checkpoint total assets has to be equal to total liability. So I inserted here a formula, which is basically total assets minus total liability, and it has to be 0. So let's say here, if instead of 33882575, I wrote 2557 because I kind of made a mistake. And you can see that this line will not be 0 anymore, meaning you have a mistake, check your number, your data entry again. Okay, so this is a very important checkpoint because, you know, there are a lot of numbers and we are all human beings, we can get confused. So once you entered all the data, you look at this line, at the checkpoint, and you make sure that total assets equals total liability. Okay? So this basically reflects the data entry. Just to show you one more time that we have the same figures in the financial statements. So you can see net assets, unrestricted, temporarily restricted, permanently restricted, exactly the same terminology. that we have here in the financial statement. I would say the non-profit version of what we've just seen with the net assets. And this is in the table here, which is called net assets analysis. Now, from here, I mean, there is another data entry for the statement of activities, which we'll go over it immediately. But from here, everything which is not gray is calculated. So you don't have to do anything. Just look at the numbers and make sure that you understand. Okay, and obviously we will go over that understanding. But this is basically the analysis of the net assets based on these differentiation between unrestricted net assets that are in fixed assets, which we don't want to touch, and the financial part of the unrestricted net assets, which is a measure of our financial stability or vulnerability in the long term. So what we see here, we have the unrestricted net assets, 33.882. This is exactly the number that is inserted here. Okay? So this is taken from here. Also, we have the restricted net assets, which I use the term RNA, something in biology. If you remember the COVID vaccines, they're all based on RNA, but it's a different RNA. It's not related to net assets, but to something else in our cellular biology. So here we have the restricted net assets, which is the sum as both temporally and permanently. Again, for our purposes, it's not important. And here we have the fixed assets, again, taken from the table that we already, the data that we entered ourselves. And then we want to calculate what is the part of unrestricted net assets which can be used for programs, okay? Which is exactly in the example that we saw in the family case. What is my financial position given the fact that I am not going to sell my fixed assets? I need them for my ongoing operations. And this is the number which is calculated here. And this unrestricted net assets for program is usually referred to in the more human language as operating reserve. Okay, operating reserve is the long-term measure of the organization's financial stability or vulnerability, and it shows what is the difference between our financial assets and all our commitments, including commitments to donors, which we didn't have in the case of families, because families don't have commitments to donors, but including the commitments to donors, which are reflected as the restricted net assets. And what we see here is that it seems that we have a significant amount of unrestricted net assets, like a huge amount of reserve, almost $34 million. But as we can see, these $34 million, $35 million is in fixed assets, something that we are unable to use. So basically, we have a negative amount here in our operating reserve. What we see here is that we had a positive operating reserve of slightly more than $1 million in 2015, but due to a deficit that we have to see where it came from, that we will see later on, due to a deficit, a large deficit, our operating reserve went from the positive to the negative, and now we have a negative operating reserve, which means we actually don't have an operating reserve, but a deficit in the operating reserve of $907,000. And that measure is the most important measure for our financial stability or vulnerability for the long term, because it looks at assets minus all the obligation, including mortgages that can be for 20 years or whatever. But for the long term, we don't have enough assets today to cover all our obligation. And obviously, we will talk later on what is the amount that we want to be able to have so that we will be considered as a stable organization. Questions? Crystal clear? Okay. So that we will have to see later on. Now we move to another part that we still have to do some data entry, and this is the statement of activities. Okay, so just to go back to our definition. The balance sheet showed us balances. Balance is for a specific date, usually 31st of December of this year compared to the previous year. The statement of activities shows us flows, income and expenses within a period of time in the financial statement within a year. So when we talk about our annual income, it's all the income that we receive during the entire year. And obviously there is a connection because the difference in balances has to be reflected as flows. So we will have to see the connection between the statement of activities and the balance sheet. Okay, if we have a change in, let's say, net assets, it has to be reflected as some kind of difference, surplus in our income minus expenses. But first, the technical part. So here, as you can see, we take the data from other parts of the 990 form. The data for income is taken from part 11, while the data for expenses is taken, or the figures are taken from part 9. Okay, so it's a little bit confusing, the Roman figures. So X is 10. If we have a 1 on the right side of the X, that is 11. And if we have the 1 on the left side of the X, that is 9. Okay, so one of the components of your financial education is to read Roman figures. Okay. All right. So let's see how we get the numbers. So 990 form. Let's go to 990 form and look for part 11. Okay. So here is the 990 form, and we look for part 11. This is part 11. Okay. And let's go back to our Excel. So part 11, line number 1. Again, the huge advantage of the 990 form that I can refer you exactly to the figure that you have to enter. You don't have to look for it. If you go to the statement of activities in the financial statement, especially the American format, it's very confusing. So line number 1 in part 11. Here, line number 1, 10,517,000 and something. And we enter, yeah. So this is the figure for income. Now, let's go back. Here also, on top of the numbers, there is also the issue of signs. Because if in the balance sheet, there was no issue of signs, everything was with a plus sign. So here there is an issue of signs, because we have to make sure that we put the data in correct sign. And again, in order for you not to get confused, there is a line, a column here with the title sign, and it basically tells you either it's positive, like income, or negative as expenses, or can be either positive and negative, so we'll see that immediately. Now we have the 2 lines of expenses, and they are with a negative sign. Now here you have to be very careful about that, because if you mix the signs, everything gets incorrect. That's why I just added this sign column so that you won't get confused. So now we have to go to part 9, lines 25, B, C, and D. So let's look at that. This is something that we have seen something similar. So let's go to the 990 form and go to part 9. So this is part 9. Now, this is something that should ring a bell to you. because when we looked at the table of the Fry-Lloyd Foundation with the distinction between program costs and overhead costs, they had a very similar format, which basically they didn't invent. They took it from the format of the 990 form. And basically, as you see, we have here 4 columns: total expenses, program service expenses, management and general, and fundraising. Okay, and if you recall, when we talked about program and overhead, we said we have program and we have overhead, which is management and fundraising. Okay, so here we have the same breakdown, and we go all the way down to line 25, which is the total. Okay, so what do we take from here? For program, we take the total of column B, that's 6938.
Why taking not the total expense?
Oh, well, because later on in the analysis, we would like to see, let's say, overhead rate. So we need the overhead separately. Okay? So, you know.
Sorry, can you repeat the question? We are not hearing it well.
What was the question? You didn't hear the question. Okay, so the question was why take the breakdown of program and overhead and not take just column A of the total expenses? And my answer was that in the analysis, if we want to calculate, for example, the overhead rate, same overhead rate that we discussed previously in terms of budget, here we can see the actual overhead rate. We need the breakdown between programs and overhead. Okay, Ahmad, this is clear?
Yes, clear.
Okay. All right. Then we take the second, which note it's the sum of the 2 expenses in column 25, line 25, column C and D. So let's go and see it. So here we have 25 columns C and D, 3,239,000 and 674. We enter them in one line here in the Excel. Okay, you can see in the upper part as overhead expenses, and it says in the title General Management Fundraising, so you won't get confused. Both of them with a minus sign, and it says here a minus sign. Okay. All right. Now we have another line which is called adjustments, which is taken from part 11. Okay, lines 5 to 9. So first of all, let's go to part 11 and then I'll explain. So part 11, lines 5 to 9. Okay, 5 to 9. All right, so here, first of all, in several or maybe many 990 forms, there will not be any values in part 11, lines 5 to 9. Okay, the reason for this adjustment is that there is a slight difference between the definition of the tax authorities regarding how income is presented and the definition of the financial statements. Now we need the definition of the financial statements because this is the definition that balance sheet and the statement of activities will coincide. So if there are adjustments, we have to put them into the table. In this case, we have adjustment only in line 95, which, as you can see, it's gains and losses from investment, which are presented in the financial statements. If we have gains or losses, we have to present them. In the statement to the tax authorities, we only present actual gains if they actually sold the investment. So there are different definitions that are not very important, apart from the fact that we have to enter the number. Now you can see that numbers here can be either with a plus or a minus sign. So we have to make sure that we put the correct sign here. The sign in line number 5 is plus 425,000 with a plus sign. So we go to our table and we enter this number with a plus sign. And note in the column sign that it appears as a plus or a minus, which tells you check the number whether it's a plus or a minus. Okay. And then we have this blue line, which is surplus and deficit. Now this is the second checkpoint. Okay, this is the second checkpoint because the change here, the surplus and deficit, has to be equal to the total change in our assets, net assets. So you see there is a checkpoint. Here is the number which is taken from line 47. And here is the number that is taken from line 38. They have to be equal. If they're not equal, you had a mistake. So for example, if here by mistake, instead of writing plus, I write minus. So you can see different numbers here, meaning that there is a mistake in data entry. So these two checkpoints will assure you that you didn't make any mistake in your data entry. Okay? Because again, we are all human beings and we are prone to make mistakes. Okay? All right, there is one or there is, let's say, one last figure that we have to enter here, and that is the depreciation. Why do we want to enter the depreciation? As I explained, in our statement of activities, there is an estimate of depreciation, which is calculated based on the lifespan of the different items that we have in our fixed asset. However, depreciation is not an actual cost. We didn't actually spend the money. And when we want to look at our financial situation, what we want to see is only the money that we actually spend. So we have to deduct the depreciation from the expenses. We have to take it out, okay? And this is done here by entering the depreciation with a minus sign, okay? So I will show you immediately where we take the figure from, but remember the sign. Sometimes people get confused here. So I added the minus here. You enter the depreciation figure with a minus sign. Now this refers us to part 9, line 22A. So let's go to the 990 form. And we go back to part 9. Part 9 is the expenses. Now here we look only at column A, on the total, because it's not important to us how the depreciation is broken down between programs and overhead. We go to line 22, and this is the amount for the depreciation. So in our statement of activities of the total expenses, 1.737 was an estimate, not an actual expense for depreciation. And when we go back to our analysis here and we enter the depreciation here with a minus sign, we can see that in the financial statement, there was a surplus, a small surplus of 90,000. But if we look at our actual expenses, they were much less. And our actual surplus, the surplus that is reflected in our financial assets, cash and savings, was much larger, was 1.8. Okay, so this is the figure that is important to us for our analysis. Okay, so basically this is the data entry. And before we continue, are there any questions regarding the data entry? Now, again, yes.
The depreciation, it's minus.
Yes, you enter here in a minus because this is how I constructed the formulas. It was possible to enter it with a plus, and I had to change the signs in the formulas. But I constructed it with a minus to remind us that we take it out of the expenses. We reduce the expenses by the depreciation. and therefore we increase the surplus. Okay? Let me explain it again. We have shown here income of 10.5. Okay, additional income due to adjustment of 425. So you can see that the total income was 10.9 million. Okay, now in the expenses, what we showed are expenses. If you add 6.9 and 3.9, so the overall expenses are 10.852. It appears somewhere here at the bottom. If you mark the range, the total expenses appear in the bottom. So overall income of 10.9, expenses of 10.8, we had a surplus of 90,000. This is what appears in the financial statement. But if we want to translate these expenses minus income, this surplus, to our financial assets, the expense on depreciation, we didn't actually spend the money. So the surplus is much larger. So we have to reduce the expenses from 10.8. This is what we have here. We have to reduce it by 1.8 more or less. So actually our expenses were not 10.8, but more or less in the 9 million. The actual expenses that we actually spent, used cash for. Okay? Understand, Iwan? Because the depreciation is just an estimate. It's not a real expense. It's not something that you pay to somebody. It's an estimate that is meant to show you that you have fixed assets that are going down by value. So therefore, we enter here the depreciation with a minus sign, and we get the surplus excluding depreciation, which will be reflected later on in our financial assets. And again, remember that when we talk about financial stability, financial vulnerability, the focus is always on the net financial assets. Because what is financial vulnerability or financial stability? Is our ability, if we have a delay in income, if we have a shortfall in income, if somebody owes us, the government owes us money and the payment is delayed by a few months, our ability to sustain the programs, to keep the programs at the same level without the fact that we have some kind of disturbance in income, disturbing our ability to continue the programs. This is what financial stability means. And for this, the only thing which is relevant is the financial assets, the cash, maybe the savings, if we can get to them, not the fixed assets. Therefore, everything which relates to fixed assets, we have to take out. So we took out the fixed assets here in the table of the statement of the net assets analysis. And we also have to take the depreciation from the statement of activities, which again is an estimate that relates to the fixed assets, but it is not an actual cost.